Good evening, ladies and gentlemen, and thank you for being here for our first quarter results of 2015. Taking you through the results will be Mr. R. Shankaraman, our Chief Financial Officer and member of the board. Post his presentation, he will be joined by S. Subramanian, Whole-Time Director of the Board of Larsen, Toubro. May I request Mr. Shankaraman to start the presentation? Thanks.
Good afternoon. Thank you for taking time this afternoon to be with us for the presentation on the quarterly accounts, first quarter of the current year. Before I get into the presentation, the results of the company needs to be seen in the context of the environment in which we are operating, which continues to remain tentative and investment shy. While the macroeconomic parameters are showing trends of improvement, the speed and scale of the reforms that is required to push this trajectory into a investment-rich momentum is of a much higher order than what is currently on display. So going forward, we do look ahead with optimism that the incremental efforts that are being taken by the government and the industry actually shapes up into a larger program which would make meaningful engagement of large productive capacities such as our company has to offer to the country's development. The presentation starts with the usual disclaimer on forward-looking statements that could be part of this presentation and the conversation thereafter. The presentation is categorized into two halves. One talks about the financial performance at the group level, and as you know, we are publishing the consolidated performance of the group. And the second part of the presentation talks about the individual segments performance. The group financial performance, starting with the order inflow. The company has, the group actually has won orders worth 26,400 crores, 264 billion rupees, which is 21% lower than the 334 billion rupees of quarter one of the previous year. If you could notice that the domestic orders at 18,000 crores has been quite consistent between the first quarter of the previous year and the first quarter of the current year. The reduction has essentially come in terms of international orders, coming down from 14,800 crores previous year to about 8,100 crores. Previous year, you might recall that there were some large orders that we won on the international markets, and these were marquee programs and not likely to keep repeating on a year-to-year basis. Since we had won those orders and those don't feature, or such kinds don't feature in the current year, there is a reduction in the international orders. However, the order wins of 264 billion rupees is broadly in line with our plans for the current year. I do want to recall that we did mention about the pattern of order inflow that is expected in the current year, which is based on the assessment of the order pipeline that we have, and it is quite likely to be skewed towards the later part of the current year. In terms of the order book, after 264 billion rupees of order win, we have an order book of 2,39,000 crores, which is 22% higher than the order book we had in Q1 of the previous year. Roughly about 25-26% of the order book is international orders that we need to execute. The positive side to the order environment today is both power and hydrocarbon, which were sectors which were not seeing much order flow in the previous year, are beginning to show signs of awarding contracts. Notwithstanding the fact that we ourselves lost a few target bids on aggressive pricing, the good news is that some of these sectors which we were waiting for orders to start acting up has shown tendencies of improvement. So consequently, the pipeline for the year as a whole appears encouraging and keeps players like us interested. The breakup of the orders, we have 45% of the orders coming in from infrastructure segment. This has been pretty much the pattern of the previous years. And hydrocarbon has contributed to 13% of the order inflow. Metallurgical and material handling, it has remained very, very quiet over the past 6 or 7 quarters. Has started showing some signs of improvement with some ordering. We are not yet sure whether it's a sustainable trend of orders that will come in from this sector, but enough to say that as compared to the first quarter of the previous year, the order inflow accrual has been better for that segment. We have heavy engineering and electrical business contributing to 4% of the order, and power contributing to 1%. The services segment of our pie continues to do well, and they account for close to 19% of the total orders that we pick in. It's relevant to note here that the orders for services are reckoned as equivalent to the income that we earn for the segment. The order book of 2,39,000 crores, we have 1,69,000 crores in the space of infrastructure. So the manner in which these orders are executed will have a lot of bearing on the revenue visibility and the margins visibility going forward over the next 3 years. We have power at 22,000 crores of order backlog, and we have hydrocarbon at 15,000 crores of order backlog, which are required to be executed. Minerals, metals and material handling segment has close to 11,900 crores of orders in the order book, followed by heavy engineering at 8,700, and the rest complete the total order book of 2,39,000 crores. The performance of the group, the revenue from operations for the quarter ended June 16 at 202 billion rupees is up 7% as compared to 189 billion of the previous year's first corresponding quarter. Of the 202 billion rupees, 66 billion rupees are from international sales, which shows a 36% growth over the previous year. You would recall that we had won large amount of international orders in the previous years, and the execution of which has commenced during the current year. And we will find the progress on these jobs reflected by increasing share of international sales in the earning chart. Manufacturing and operating expenses have grown by 9%, and these are in line with the plans that we've had for the sectors where we are executing the jobs. We've also, during the course of last year, and in July 2014 to be more precise, operationalized the second unit of the Nabha power plant. And the operational cost of this power plant is also embedded in the current quarterly manufacturing and operating expenses, which is not the case in the corresponding quarter of the previous year. Staff costs have risen sharply by 19%. This is largely due to the large-scale engagement that we have in Middle East presently, which is not evident in the first quarter of the previous year. We have augmented many of our businesses which are beginning to take roots in Middle East, namely the power transmission, distribution, infrastructure, as well as hydrocarbon. Consequently, half of the increase on account of the staff cost is on account of Middle East augmentation. The balance, of course, represents the headcount growth that we have had in our services business, as well as the normal pay revisions and retention amounts that we dispense for our standard operating businesses in both the parent company and the key subsidiary companies. Sales administration and other expenses have remained pretty flat at 13 billion rupees, and the total operational expenditure at 179 billion rupees is up 9% as compared to the quarter one of the previous year. Consequent to the increase of revenues at 7% and operating expenses by 9%, the EBITDA margins have declined by 1.9% from 13.2 to 11.3. It's relevant for me to mention here that being a project company, quarterly measures of EBITDA margin are not indicative of the yearly trend, and we do not expect to use these statistics to deviate with the guidance that we have given for the margins as at the end of the year. Interest expenses have come down from 7.74 billion rupees to 7 billion rupees. Combination of divestment of the Toubro port, which was actually debt heavy, as well as the refinancing that we have done in the course of the quarter, that has enabled us to have a 9% reduction in the overall interest cost. Depreciation, the previous year had the implication of surrender and its one-time cost of two road projects that we had given back to NHAI, and hence they had to be accounted as part of the depreciation amortization chart. In the current year, we do not have any such events, and consequently, they are more normalized at 6 billion rupees. Other income at 2.5 billion rupees is par for the course, and net of taxes, we have profit of 6 billion rupees, down by 37% as compared to 9.67 billion of the previous year. It's important to bear in mind that the previous year's 9 billion rupees has the profits of 1.1 billion rupees on account of divestment of our stake in the Amra Port project, which is non-recurring in nature. Looking at the segment, we present our financials based on the 10 segments, and they are infrastructure, power, metallurgical material handling, heavy engineering, electrical automation, hydrocarbon, developmental projects, services business in form of IT and technology services, financial services, and the rest. Looking at few of the segments, we have infrastructure and hydrocarbon segment charts, where infrastructure we have revenue of 82 billion rupees, up by 16%, while infrastructure segment has not seen growth in order inflow, but it reflects the progress that we are achieving on the order book. So consequently, the revenues have grown well by 16%. Of the 82 billion rupees, 24 billion rupees is on account of sales from international contracts, which is sharply up by 74%. And this is a result of execution of the order book that we have from the international clients. The EBITDA margins of this very large segment of our company has improved by 40 basis points, moving up from 10.3 to 10.7%. Hydrocarbon segment has reported a revenue of 21.9 billion rupees, up by 41% as compared to 15.53 billion rupees of the previous year. All of us do remember that the first quarter of the previous year saw considerable reversal of fortunes for hydrocarbon business on account of some of the challenges that we had faced in our international jobs. But it was as expected. The current year is expected to help the business recover back to its usual growth mode, and we are in the transition of completing the legacy projects and moving on to the current projects, which are more healthy and a bit better. So consequently, there is a recovery of EBITDA margin from negative 57% in the previous year to 4.2% in the current year. It is important to bear in mind that having invested in infrastructure for hydrocarbon business in the Middle East, it is going to take a few more quarters for the business to play out fully by the time we expect to hand over the legacy projects completely to the customer and settle their respective accounts. In terms of power segment, the segment revenue is up by 12% at 11.17 billion rupees, and we also see a growing trend of international revenue as we are executing a couple of power projects in Bangladesh, and the projects are on course. The EBITDA margin has dropped from 20 to 9.8%, largely reflecting the job mix. Much of the jobs that we are executing currently are in early stages of execution and hence do not meet the threshold for margin recognition. We do hope as we complete these jobs and move forward, the subsequent quarters will begin to capture the margins embedded in these jobs. In terms of metallurgical and material handling segment, the challenges in this business and the sector as a whole continues. There is lackluster investment climate. Both public sector and private sector are not investing in the segment as yet. So consequently, as the order book depletes, the revenue takes a declining curve, and we see the revenues at 4.81 billion rupees, down by 48% as compared to the revenue from the segment in the previous quarter. Consequently, the margins reflecting both slow progress on jobs as well as under recovery of fixed cost reflect a negative minus 0.3%. Heavy engineering has reported a segment income of 6.22 billion rupees, down by 24%. Very much like the metallurgical and material handling, the depleting order book in heavy engineering segment has caused the loss of revenue, while the European crisis and the consequent depreciation of euro has resulted in competition getting severe, particularly from the European markets, we find that the price levels continue to challenge of the limited opportunities that are available. The decline in oil prices have not helped the cause either. Consequently, we do expect heavy engineering business to remain in some amount of turbulence for the next 1 or 2 years before they get back to much better times that we have seen the business do in the past. Heavy engineering business is also housing some element of defense manufacturing. So if and when the defense manufacturing becomes much more interesting and engaging for private sector players such as ourselves, we should see the fortunes of this segment improving. In terms of electrical and automation, there is lackluster demand in the market. The market is actually degrowing, and the business has done well to stay at 2% growth on the top line. The revenue growth, revenue at 9.81 billion reflects the 2% growth. And the EBITDA margins have moved up from 8.9 to 10.5, largely because of the operational efficiency as well as the soft commodity prices that are evident to the segment. The developmental projects business has a segment revenue of 12 billion rupees, down sharply from 21.47 billion rupees. This is largely due to the fact that the prior year had the proceeds from divestment of the Toubro stake, which is not there in the current quarter. Consequently, the EBITDA margin from an elevated 68% is at a more normalized level of 26.1%. Financial services business has done well. The disbursements have grown by close to 30%. The revenues have grown by 20% at 17.83 billion. And the NIMs have remained positive and stable, resulting in stable EBITDA margin of 15%. Information technology and technology services has had a good run, apart from new client acquisitions and larger share of the spend of our clients overseas. The revenues have grown by 21% at 21 billion rupees. It is also a fact that the favorable currency has helped the revenue growth. In dollar terms, the growth has been around 10%. EBITDA margins have improved because of better scale and improved on-site offshore mix. Consequently, the margins at 21.2% reflects a 1% improvement over the previous year. The other segment is really a residuary segment where we have shipbuilding, we have realty, we have construction mining equipment and other small industrial machinery and other products. The segment has grown well at 19%, largely reflected by the growth in the valves business as well as in the construction equipment business. With the mining activity beginning to show improvement, we do expect the mining equipment business to look better. And with the construction activity picking up on the back of infrastructure development going forward, we do expect this segment to report reasonably strong revenue growth. The EBITDA margins at 21.2% remains healthy and reflects a 0.6% increase over the previous year. So thank you very much, and we will now open the floor to questions.
So this is Rahul from the Hindu Business Line. Your PAT has declined, so is it only due to international orders not coming, or is there any other reason?
The profit after tax for the quarter, the decline is largely on account of two factors. If you recall, the profit after tax in the previous year was 967 crores. Now, it had an exceptional gain. It's a normal operating gain, but of an exceptional nature. It doesn't happen every year, of almost 1,100 crore on account of sale of Toubro. And it also had a unique situation where we had to report in hydrocarbon business close to 700 crores of cost overruns and claims unsettled. So the net effect of last year's PAT had about 400 crores of extra gain. So in a manner of speaking, if you really take away that 400 from the 967, you're really looking at a 500 crore PAT, which also had, if you had noticed, about 190 crores of gain from sale of our stake in L&T Finance, as well as L&T Finance selling its stake in City Union Bank. So if I adjust for that, the profit of 350 crores last year is actually moved to 600 crores in the current year. So while optically it looks like an underperformance to the extent of 38%, if you strip the profit and loss of the key transactions and lumpy transactions, our businesses in the current quarter have actually done better. And that is evident in the cash flows which you can see in our websites, that the cash flow is improved considerably. It has doubled. The cash released from operations have doubled in this quarter as compared to the last quarter.
So this is Naveen Shetty from Bloomberg TV. Sir, last quarter you have given a guidance of 15% for both revenues and orders. So do you think by this year end you are on track with the order inflows as well as the revenues?
See, the guidance is under 2 months old, and we do not have anything yet to suggest that we need to revise the guidance. Very early in the year, we continue to remain optimistic, though cautiously optimistic, because the environment is yet to play out completely. So we do think that at the moment we will go with these guidance, and as and when we come across a situation where we think the guidance are not likely to be met, I think it's our duty to come back and inform the market.
So one last question on value unlocking. Are you looking out for any of value unlocking in any of your assets right now?
It's a constant endeavor. I think our effort is to make sure that we create shareholders value, and as a part of that, as well as portfolio restructuring, we as a management constantly look at what are the assets that are mature and that can be finding a better home than what we do. Some of them are strategic, so scale does not matter. Some of them are just for scale, and if scale is not to the satisfaction, we would tend to look at them as an asset for sale.
Anything they're offering right now, sir?
Oh, lot many. We have a lot of portfolio. So when we're talking about underlying, construction, road sector assets. We have power sector assets. We have some in the industrial space. So L&T is a bouquet of several businesses. So I think we constantly, like in the past years, have been constantly looking at.
I think the idea is to focus the company into certain activities. We have gone slightly diversified, and some of the strategic investments we have done have worked, some of the strategic investments we have done are not worked. And therefore one constantly looks at the portfolio, Shankar Raman says, and takes an objective view of it. Some of those which have worked, we grow. And some of those we are not worked out. From our point of view, we sell, and maybe it's good for somebody else. And that's the way one looks at it. And that's a constant endeavor.
Ashwin Mohan here from ET Now. Here, sir.
Yeah.
Good afternoon.
Yeah.
My first question is on some of the sectors you spoke about. You mentioned during your statement earlier that some segments are going to face a turbulent phase because of volatile environments. But however, on the flip side, if you could point out which are some of the top 3 segments where you expect that they will stem the tide and will have a healthy order pipeline going ahead. That's the first question. And the second question is, has the search ended for finalizing the CEO of L&T Infotech? And if yes, when can we expect an announcement on that front?
Okay, on the first question, which is on the sectors which we expect to grow well, I think the infrastructure sector would continue to perform. The fact remains, as Shankar said, that some of the announcements being made for it to get to the ground and to reflect on, let's say, a tender or a prospective order is still not that visible. So we remain cautiously optimistic on that. But having said that, whether it is buildings and factories, whether it is transportation, whether it's heavy civil, power transmission distribution, or the water, we do find that where we are in, we have achieved our first quarter results. And as we look at it, we do find that Q2 should also be okay. And therefore one tends to take a view for the year that as we are budgeted, things should happen. And that's the biggest sector. And if that does well, at least 50% of the company is through. The second part is our services business, which consists of 2 portfolios. One is the 2 IT-related companies that we have. One is L&T Infotech, and second is L&T Technology Services. As we look at them, there seems to be fairly reasonable traction there. There could be some slippage from the overall budget on L&T Infotech side, because one of their sectors, which is the energy, due to the oil price dip, is not doing that well. We don't see enough traction there because energy companies are not spending so much on IT because oil prices have come down from $100 to $50 odd. And there's a general rumor or forecast that it could come down further because of Iran opening up. That portfolio is doing slightly bad, but other than that, L&T Infotech and Technology Services seems to be doing reasonably well. The financial company that we have, L&T Finance, a separately listed company, I cannot talk too much out here, but as we see it, we seem to be getting the results that we want from that company. Taking it forward, the real estate, both L&T, what we do within the organization, and L&T Realty as a separate company, both seem to be doing reasonably well. It's also a fact that in this environment, when there's an oversupply of built-up spaces, especially in Mumbai, we still do seem to have traction from whatever we are doing, both at Parel and at Powai. And we continue to hope that this trend continues for the year. So these are the three broad portfolios which are doing reasonably. The portfolios where we have a problem was explained in the slides that was put forth. Hydrocarbon, we should not see the kind of issues that we had last year, and therefore that portfolio should do much, much better compared to last year, though we are yet to close out all the issues that we have. Heavy engineering and defense, heavy engineering we are okay, except from the process side, but on the defense side, we do hope that some of the big bids that we have made, based both on the defense sector opening up as well as keeping into account the Make in India campaign, we see some positiveness as we go by. It is a tough area because dominated by the government, dominated by other interests, and therefore it does take time, but I think we are well placed to see how to take it forward. So all in all, as you see, some of it doing reasonably well as we thought, some of it done with a lot of foresight and strategically done investments. We do have some issues as we go by, but we do hope to overcome it as we see it. On your second question, where you had asked about onboarding the chief executive in L&T Infotech Limited, I think it's a positive scene as we see it. Unless there is an official announcement, one is not prudent enough to mention about it. I think you'll hear some news from us very shortly.
I'll slip in one more question, sir. The government is clearly betting big on the renewable energy space, and it has, in fact, set up very ambitious targets as far as ramping up output is concerned. Many conglomerates are evaluating this space. What about L&T?
As you are aware, one of the main renewable energy spaces where we are present is solar. We are present in all the three spaces of solar, that is solar PV, solar crystalline, and solar thermal. The only solar thermal plant in India which has been put up by us for Reliance, which gave the order to Arriva, and Arriva L&T together put it up in Rajasthan. It's a 110 or 120 megawatt plant that has started functioning. On the PV crystalline side, last three years, we have been commissioning about 200, 210, 220 odd megawatts every year. Since last year, for the price of solar plants, which was started at about 12 crores per megawatt, went down to 10, 9, 8, 6, has even come down to 5.2, the recent bid that has gone in Madhya Pradesh. In our view, the price is good, but whether it's sustainable at the moment, we are not sure. Because the cells are made by a few dominant players in the world, including a few Chinese companies. Ultimately, it's a cost of the panel plus the various connections that you do, the substation and the evacuation. If the policy environment is such that it can capture this and take it forward, and the developers who put up these plans are given adequate payment from the state grids and utilities, then the sector will grow. A clear affirmative action should come in that any state grid which supplies power should have some percentile from renewables, some percentile from coal-fired, some percentile from nuclear and hydel, so on and so forth. We do not have such a policy. The broad framework that we have is renewables are important, it saves carbon footprint, and it is good to have. It is under that pretext that we are working. At the moment, we are in this sector, but let's see how it pans out. So we have the technical talent, we have the capability to put up plans, we are probably the largest solar EPC developer in the country, but we need to see how it grows.
So will you be open to exploring the inorganic route in this space, or will you be content participating in tenders?
We are an EPC company, and we will place emphasis on being that at the moment.
Thank you, sir.
Yeah.
Hi, good afternoon. Rachita here from Media. A couple of things. To begin with, if you can give us a sense on the hydrocarbon side, what is the quantum of legacy orders that you are referring to? And you said they should be over in the next few quarters. So by when can we expect the impact of those orders to stop reflecting in the results? Also, are there any fresh orders in the international market that you are tendering for? I mean, what is the pipeline looking like for the hydrocarbon business?
Well, insofar as legacy orders are concerned, we expect to get out of these orders by end of this year, fourth quarter of this year. We will, over the next 3 quarters, gradually see one after the other the projects getting handed over. But 6, 7 projects, as I mentioned in the earlier conversation, were stressed. Half of them have been handed over, account settled, the balance half will be done. So I don't really expect the following year, 16, 17, to have any remnants of these legacy orders. Insofar as the new orders are concerned, we have a large order that we are executing, which was acquired in the previous year, which is for a gas gathering center in Kuwait, and that's about the largest order that we are executing. Early stages of the order, so far the progress has been satisfactory. But as you know, in most of these projects, and especially large projects, it's only towards the end of the project you will really come to know the final positioning as to how we are insofar as the execution is concerned, the punch lists are concerned, the costs are concerned, etc. So I think at the moment we are happy at the way it's progressing, and we'll have to wait. Insofar as what we want to do going forward, having invested in an organization in Middle East, our first priority would be to ensure that the legacy projects are satisfactorily completed before we ramp up our order book. But at the same time, we are looking at opportunities as they come up, and we are trying to pick our spots as to where it would make sense for us to compete.
Fair enough. On the domestic side, can you give us a sense on infrastructure projects? I mean, of the current order book, are there any orders where there is a concern of the slow-moving orders? And also, in terms of execution, how has that panned out in the second quarter? And is there a pickup in terms of the execution going ahead?
It's a pretty complicated question, Ruchita. Yeah. I'll try to understand what you asked and answer the same. See, the backlog is high at about 1,60,000 crores on the domestic infrastructure side. To say that every order is going well is not correct from anybody, and I would also not like to say that. Predominantly, most of the orders are going reasonably well. The question that arises is how do we look at it at a given point of time. For example, if you take a sector like buildings and you take residential, the fairly large residential portfolio that we have, the residential construction that we do, predominantly these orders are with private sector developers. Now, how does a private sector developer get his funds in? He puts in certain equity of their own, they get in some debt, and they also depend on advances from customers. Now, in a situation where the economy is still lukewarm to full prospects, if the advances from customers do not kick in, and that's why you have this huge amount of built-up stocks not being sold, naturally the developer is going through a strain of collecting money, and therefore he is under strain to pay us. Now, we are fully mobilized in some of these big projects, and if the money doesn't come in, we also cannot use our resources to the full extent to provide the total services that is required from that point of view. So one tends to go a little slow, and one tends to be cautious under the circumstances, which is correct. The developer also may request us to go slow on such cases. There are certain government projects, both from the central as well as the state, where due to the budgetary constraints or the resources pull on the governments, sufficient funds are not being allocated. Now, frankly speaking, these projects, whether it's on the power transmission distribution side or on the water side or even on the road sector side, we can maybe do it a little faster. We have the capability to do it a little faster. But if sufficient funds are not allocated, we can do it faster, but it will remain as work in progress or a billed item which is not paid, and therefore your outstanding increases, your working capital goes up. So one tends to be cautious in some of these matters. These are by and large not significant. We are careful, cautious about it. But at the same time, to overall look at it, we are in a tight situation, and maybe it takes another couple of quarters before things improve much more radically than what they are. And then one can tend to be a little more positive than being cautiously optimistic, as we say right now.
One final question on the margins. I mean, the way this has declined in the first quarter. How how difficult would it be going ahead to bring it back to the levels, I mean the recovery, especially given how competitive the market is looking right now?
At the cost of repetition, let me say that quarterly margins are not reflective of how the year is going to pan out. The quarterly margin is a function of several levers that are at play, including the margin that we realized on sale of Damra port in the previous year, when you're comparing the margins of the previous year with the current year. At the moment, I think we feel quite satisfied at the margin trajectory as we see on the first quarter, in the context of our guidance of the year, where the overall margins from businesses other than services businesses, that portfolio will increase by 100 basis points, is what we had indicated. We do think that we are on course as we see things now.
Thank you.
Sir, this is Aman from Reuters. I just on the outlook part of your press release, you mentioned the unhurried pace of reforms in India. I just wanted to understand if you could explain a little bit further in terms of what really has been your experience over the past year, and if I could push you to give me a timeline as to when you see this capex cycle actually coming in, because you also mentioned that there is some visibility on outlay in the public sector.
See, the capex has two elements. One is the private sector capex, one other is the public sector led capex. Private sector today is in a very difficult situation by and large, speaking generally for the sector. It has soft demand situation, it has capacity underutilized, it has stretched balance sheets, and generally the supply chain is liquidity constrained. The input cost, while the commodity end is quite soft, the labor cost and the funds cost are high. So you have a peculiar situation where before private sector comes to invest or undertakes a program to review further investments, the overall viability of the business should improve. So only then will private sector come into the market. Until then, what do we do? Now, there are a lot of things to be built in the country. Infrastructure has to be built. The capacity debottlenecking has to be done. So we do expect the NTPCs, the NHAIs, the NHPCs to continue to placing orders. Fortunately, thanks to the physical conditions improving, thanks to decline in oil prices where the current account deficits have put less pressure on the balance sheet of the country. Today, and the subsidy, not having to bear the burden of the subsidy. Today, we find that the public sector balance sheets have cash flows to invest. And that is why I was mentioning earlier that hydrocarbon investments, and largely I was referring to ONGC, which are quite silent for the last few quarters, have now come back, and 2 or 3 bids have got announced. We won one, we lost one, but the fact is they've started coming up. Likewise, NTPC have announced some of the orders. So SAIL came and placed some orders for the material handling system. So consequently, I think we see some visibility of public sector leading the effort on capex formation. Now, this hopefully will create some momentum. The financial conditions of the banking system needs to be resolved. The equity market needs to get a little more interested in the private sector expansion, and the global headwinds need to settle down somewhat. All of this needs to happen for the capital expenditure of the country to go up wholesale. So we need to, we'll have to cash on incremental gains that we see and build a case for stronger period. My own assessment is, I think it's a matter of a year to 2 years before you will see the conditions that were there in 2008 before the global meltdown coming back.
And on this, on the public sector orders that you're seeing that have started coming in, how recent is this? I mean, in the past, how many months have you seen these coming?
Well, even the last year when we reported the results, there was a significant increase in the domestic orders as compared to the international orders, as compared to the previous year. Here I am comparing FY15 with FY14. Now that itself was early indication that the public sector was beginning to invest and that is continuing through the current quarter. And we saw in the charts that 18,000 crores of domestic orders that we picked up in the first quarter of last year, it's similar quantum that we have picked in the current year. So given the fact that competitive intensity remains high, there are a lot of people who want to look at these opportunities because they are few and far between. It is a good sign that the government is beginning to consider. But unless bank capitalization, all of that gets resolved, liquidity flow is resolved, it's going to take some time, and it's a patient game that we need to play now.
You have seen National Highways Authority come out with many tenders. We have been a reasonably good beneficiary of it. We have won 6 out of the 8 tenders that they came out with. You have seen APDRP schemes come out with a lot of both distribution as well as water projects. We have been a reasonable beneficiary of it. So you do see trends. So to say that it's totally bad is not the right thing, but always the eternal hope is it can happen faster and faster.
And just the last question on the divestment, that I believe as we were talking, you've put on an offer for L&T for like 15% of the shares. Any indication you can give us on when the next divestment would come?
No, first let's complete what we want to do before we talk of the next. At the moment, the plan is to look at L&T Infotech as an asset and see what we need to do in that space. But regulations would demand that if there is a next divestment coming in, that you will come to know as quickly as I know. So.
Hi sir, Shubhra Tandon from the Financial Express. I had a question on the roads portfolio. How has the traffic moved in the quarter, and are we seeing any significant uptick from last quarter or the previous quarter of last year? So is there any change?
I handle the constructions, he handles the traffic, so he will answer that question.
As compared to quarter 1 of last year, we see a 9% growth in the revenues of the portfolio of commissioned roads. Normally, the increase in revenue is a function of both the inflation, which is reflected in the higher toll rates that gets fixed, as well as increased traffic. The inflation adjustment is done on wholesale price index, and yes, last few quarters, it's been in the negative territory. So I have reasons to believe that the 9% growth that we see is largely arising out of increased traffic.
Hi, sir, Rakshana from CNBC. Just a follow-up question on the slow-moving orders. Could you help us with the percentage of the entire order book? How much would be slow-moving? And second question on the working capital for the company. How are you placed right now? What is the position on working capital?
Slow-moving orders could be about, out of that 2,38,000-39,000 crores that we put out as order book. Our assessment could be about 5,000-6,000 crores of that is in the category of slow moving. That is as we see today, and every 90 days we'll keep reviewing this as to whether something has gotten faster or something has gotten slower. So not a very worrying percentage. So we do believe much of the order book, or most of the order book, is in reasonable shape. As far as working capital is concerned, I think we have peaked. Working capital has been around 25% of our revenue. It's been so for the last 3 quarters. It entered into 23-24% trajectory in December 14. It stayed around that in March 15, and it is around the same level in June 15. I'm looking forward to times where this will improve to maybe 23-22% going forward. Our own effort is to bring it down at the earliest. But this is something that we ourselves cannot wish and do. The environment has to support. The customers have to be enabled. The vendors will have to feel the low-cost funds being available to them to be able to offer better credit, etc. So it's an entire chain of money flow. So our sense is that this year, by the end of this current year, it will tend to show improvement, but the quantum improvement could happen in the following year. But I think we have contained the worst of it and dealt with it reasonably well as an organization.
Just one more question on the power sector. We've seen some improvements, and you say that that's one sector where you see some positive moves as far as ordering is concerned. How do you see the execution cycle in the power space for the orders that you have?
I think the execution has by and large remained around the timelines that we have, 42 months thereabout. So it's not as though the clients are asking us to execute any faster than normal. On the jobs that we have, if the jobs are well chosen, where there are no issues of clearances, no issues of land, etc., the jobs tend to progress well, and that's the comment I made in the context of Bangladesh gas projects that we are executing. We're quite happy with the execution that is happening. Or the MP state power project that we are executing, the Rajasthan state project that we are executing after some initial delay on clearances. They're moving okay. They're moving okay.
But all in all, there's 22,000 megawatts of installed capacity, and we need a lot to be done in the power sector for us to move forward. There's a huge under capacity utilization. Many of us are starving for orders, including our own EPC power. And I hope these coal blocks which have been auctioned out get implemented fast and people start mining out. And some of the projects that have been announced get to financial closure and to pouring the concrete, as we call it, much earlier than what can be anticipated. There is a huge power deficit. Some states have got extra power, but they have agreements by which they cannot wheel out. There are other states which are highly deficient. And power is going to be critical for the economy to move forward. And therefore, there's an absolute revolution required for it to be taken forward. It's imperative, it's very critical.
Yep.
Thank you.
Thank you very much.